Hey traders, Nick Shaheen here, revisiting Lucid. I did this, I think, on the 26th. I did a video, and this is a follow-up. Why? Because it fell like 8% since then. Yeah, it double bounced on the same level where it's at today. Today is the 31st, last day of August. A couple of things happened. In my last video, I was pretty clear about levels. I didn't tackle the fundamentals as much because that's on you. You can do your homework. What I'm trying to do is help people read the charts who don't know technical analysis. I learned this stuff on my own. I'm certainly not a certified Wall Street expert. I'm an engineer who figured this stuff out, and believe me, it is not rocket science. It's all repetitive and very, very simple. They overcomplicate things for you. And let me show you the lines I drew last time. The video had good response. I had just a handful of thumbs down. But no insults, which tells me that I'm getting a little more, what do you call that, mature with my comments, less abrasive. So these lines are what I drew last time during the video. I said that there was support around 21, but if it's lost, I wouldn't freak out because secondary support around 20.9, this one right there. And if that failed, I mentioned 1990 as support, which is the base of this candle right there. Guess what? We're right there. 1996, good year. 1996 is today's close. And it 2 days ago, not 2 days ago, which was also the low from yesterday. Not a good news when you start banging on that low when you absolutely need to hold it. So what happens if you lose that? It just makes it wishy-washy. So the whole zone, see that little box? Base, imperative to hold. The whole zone is support because it was a hard floor here and a really hard floor there. Look at the rally that came after this. Look at the rally that came after this. And it took them a long time to get back to it. Now, someone can argue that losing this created a target down here anyway. Some sort of a head and shoulders, not quite because of this weird candle here, but if this wasn't there, somebody will draw a line right here and tell you, oh, this is a head and shoulders. The downside of the head and shoulders is usually as big as the tallest part of the head. So if that's the case, we're talking 22, so $5 ish from 22. So 17 should be the target, which would agree with this one. You can't deny that yet. I can tell you that the whole base is support. So where the bulls will step up depends on just sentiment. If you're a bull and you love your stock, this is your chance to defend it. Otherwise, the bears have control. Why would I say that? Because every pop is being sold along the way. So there's a descending channel here. This is a 4-hour chart, sorry. So if I go to 60-minute, this is more clear how it's a descending channel and every pop is getting sold. Every pop is getting sold. So what happens is it gets to here, people get stuck because they jump in with FOMO at the wrong place and then they're stuck and there are more people trapped. And then they try to hold the base and then they lose the base and then the base becomes resistance. Look left. This was the floor right here. They popped off of it. They came in and sold it. They tried to hold it. They fell apart and then now it became a problem. So now rinse and repeat, 22 is this problem equivalent at a lower level. So it's not good to anticipate snapping out of the channel until it actually happens. Step one is stop making new lows. They tried here, they popped, guess what? They sold it, they lost it, they made a new low. They're trying here. So this point is probably the same. So onus is on the bulls to say, no, this is not the same as here. When we pop, we're going to go out. Step one, pop before, meaning if you lose this, it's ongoing, right? So I'm not saying short the stock, but what I am saying, what I said with Hyliion the whole time, I wouldn't add to my longs. If I loved the company and I invested X dollars, I know nothing new right now other than the fact that Wall Street hates it recently. So regardless of how cool the car is, regardless of how successful the people are in the company and what the intentions are and whatever is coming down the pipe, it doesn't matter if they won't buy it on Wall Street. So Why predict the pop out of the channel until it starts happening? Step 1, stop making new lows. Step 2, maybe I did this last time, I don't remember, but I'll do it here. So how does this end? How does this work out to where you snap out of it? Let me visualize it the way I see it could happen. So if you make a bottom, meaning you don't make new lows, because if you make a new lows, regardless, if tomorrow it opens down here or something, then you have to say everything I'm saying now from a lower base. So lower highs is okay. Stop making new lows. So arguably, something's got to give right now. And if they pop a little bit up, then they're going to face sellers right here. This is almost a guarantee. And if they are able to take them out, then they made progress. Rinse and repeat, same process again here. Boom, hit, that's okay. Just continue on the higher low base trend. So you stop making new lows, you snap out of the descending trend. This is not a trigger for me, it's just progress. And then you hit a level. Now the level is more serious. And then if you fade a little bit, that's fine. Just don't make a new low. So you make a higher low and a higher low as you tackle each problem, and a higher low as you tackle each problem. By problem, I mean a prior ledge that you lost. A prior ledge that you lost. So eventually, you start building enough higher lows and tackling enough of these to where the channel becomes ascending. You start doing this. This will be a problem. This whole zone, I think, is insurmountable without a significant headline. So if you ever get a pop into any of this area here and you're stuck long and this gets you out of trouble and you say, oh, oof, thank goodness I'm back to even, I would get out and reset the trade somewhere else somehow where it's not, where it's not so time sensitive. Like if you're using options, for example. It's easy to sit on stock. It's not so easy to recover when you buy calls because they just get decimated quickly and time is of the essence. Whereas if you even people say, oh, I'm buying in the money leaps. It doesn't matter. They do better than shorter dated calls that are out of the money, but they're not foolproof. They still do badly compared to stock itself. Anyway, so what's the point? What's the conclusion here? So if my brother comes to me and tells me, hey, I'm stuck in this company, what do I do? I was like, why did you get this stock? What did you get into the stock? If he had a reason, it's a valid thesis. Who am I to tell him, no, you're wrong? I don't know enough about the company. Maybe he did his due diligence and found something better than I did. So he bought the stock. Okay, then he wants to average down. I say no, because it's a speculative bet. You say, what do you mean speculative? It's a real company. It's got hundreds of people working for it. Speculative meaning they don't even have a production line yet. They don't have a P&L. Therefore, by definition, it's speculation that in the future it will have those things, which is the important part for Wall Street. It's not important that you say you're going to do it. It's more important that you show that you're that much closer and then eventually having it. So you're speculating that they will succeed. So it's not an insult. It's just a classification of the trade. Like I would even hesitate to average down in good companies, but I can see people doing it and understand why. But to throw more money into a company that does not have a P&L is not something I would do. So find a bottom first, make progress. If I'm looking to get long, the options markets offers solutions. For example, so this is an E-Trade practice platform. If you've never looked at one, this is an options chain. So you have puts on this side and calls on this side, and you can choose whatever date you want. So if I'm looking to buy shares right now, I could spend $20 per share, right? If I wanted to buy 100, that's 100 times 20. If I wanted to buy 1,000, it's a big pile of money. So how can I get long with less money out of pocket? Well, one way to do it, and this is pretty dangerous for somebody that doesn't hear the first part. If I'm looking to buy shares, I personally would rather sell puts instead. Why? I collect money for the opportunity to buy shares lower. You heard that right. If I sell a put, it's a bullish bet on the company because I'm saying, hey, I want to buy shares, only lower. Any takers? Somebody that's afraid, they'll say, you know what, I'll buy insurance. Yeah, I have 100 shares, I'll sell them to you. They'll give me $140 today to promise to buy their shares at $15. So the worst case scenario is me owning Lucid shares at $15 in the next 100 days. And I get paid for it. So that's the kind of thing that I would do with a company like this, but I'm not going to because I don't like the company. So I said personal preference. I want to see a P&L first to where I can put math and say, okay, 1 + 1 = 2. I don't want to speculate on however many they're going to produce and when. Lucid is a high dollar car, which will target the high end income. And maybe they have more cars that are cheaper down the line, but I think that's the first one out the door. Beautiful. Great range, great technology, but it's not going to be mass market. It's going to be niche, targeting high-end people. So, it's just not my style. All right, so enough of it. The Bulls have a tough job this week. They need absolutely to hold this, and hopefully the stock market in general helps them by popping up a little bit. The Bulls are in control in the stock market. So that's another problem. All of this is happening while we have the strongest bullish market ever. So imagine what if the market's correct in general. You think this one will hold up here? I doubt it. All right, Nick signing out.